A forward rate agreement, FRA, is an over-the-counter derivative contract that allows two parties to lock in an interest rate today for a loan or deposit that will occur in the future. FRAs are widely used to manage interest rate risk by fixing future borrowing or lending costs. The contract is based on a specified notional principal, although the principal itself is never exchanged. Instead, only the net interest difference is settled in cash. The long position in an FRA is effectively the borrower and benefits when market reference rates rise above the contract rate, while the short position benefits when rates fall below the agreed rate. FRA notation identifies both the contract's expiration date and the maturity of the underlying loan. For example, a 2x5 FRA expires in 2 months and references a 3-month loan beginning at that time and ending 5 months from today. The forward rate specified in the FRA is determined using arbitrage-free relationships derived from the current spot rate curve. The objective is to establish a rate that makes market participants indifferent between locking in financing today and waiting until the future borrowing date. This forward rate therefore reflects market expectations embedded in current interest rates and ensures consistent pricing across maturities. Pricing an FRA requires calculating the forward interest rate implied by the current term structure of interest rates. The process uses observed spot rates to determine the rate applicable to the future borrowing period. Under no arbitrage conditions, investors should earn the same return whether they invest for the entire period immediately or invest for a shorter period and then reinvest at the implied forward rate. As a result, the FRA contract rate equals the forward rate derived from spot rates. This relationship ensures consistency across money market instruments and prevents arbitrage opportunities from arising in interest rate markets. The value of an FRA changes after initiation as market interest rates fluctuate. At inception, the contract has zero value because the agreed forward rate equals the prevailing market-implied forward rate. Subsequently, if market forward rates rise above the contract rate, the FRA gains value for the long position because the borrower has locked in financing below current market rates. Conversely, if rates decline, the contract becomes more valuable to the short position. FRA valuation involves determining the present value of the difference between the contract rate and the newly implied market rate over the underlying borrowing period. A distinctive feature of FRA valuation is that settlement occurs at the beginning of the underlying loan period rather than at the loan's maturity. Because the economic gain or loss relates to interest that would have been paid at the end of the loan period, the settlement amount must be discounted back to the FRA settlement date. This adjustment ensures that the cash payment accurately reflects the present value of the interest savings or costs associated with the contract. Understanding this discounting mechanism is essential for calculating FRA values correctly and interpreting the economic significance of FRA settlements. Interest rate swaps are agreements in which two parties exchange streams of interest payments based on a common notional principle. The most common structure is a fixed-for-floating swap, where one party pays a fixed rate and receives a floating market reference rate, while the counterparty does the opposite. The fixed rate agreed upon at initiation is known as the swap fixed rate or swap rate. Similar to FRAs, the notional principal is generally not exchanged. Instead, only the net difference between fixed and floating payments is transferred. Interest rate swaps enable institutions to manage funding costs and interest rate exposure efficiently. The pricing of an interest rate swap is based on the principle that the present value of expected fixed payments must equal the present value of expected floating rate payments at initiation. The swap rate is therefore determined using discount factors derived from the spot rate curve. The resulting swap fixed rate creates a contract with zero initial value to both counterparties. Swap rates across different maturities form the swap rate curve, which serves as a widely used benchmark in financial markets. Because swap rates reflect the credit quality of major commercial banks, the swap curve plays a central role in fixed income valuation and risk management. After initiation, the value of an interest rate swap changes as interest rates evolve. A party paying fixed benefits when market swap rates decline because its contractual fixed payments become relatively attractive. Conversely, a party receiving fixed benefits when market rates rise. Swap valuation can be viewed as the difference between the present value of the fixed-rate bond component and the floating-rate bond component embedded within the contract. This bond-equivalent approach provides a practical framework for determining swap values. FRAs and interest rate swaps together form essential interest rate derivatives used extensively for hedging, valuation, speculation, and asset liability management within global financial markets.